Up to this point, we've established how price moves, who participates, and why effort does not automatically produce results. So in this lesson, we're going to place those mechanics into an environment now. Markets do not move randomly, they operate in market states. And there are only two states that matter: balance and imbalance. Everything you observe in price behavior is a function of which state the auction is currently in. So let's start with a balanced market state. A balanced market is a two-sided auction. This is where both buyers and sellers are willing to do business at overlapping prices. Liquidity is usually present on both sides, and participation is active but constrained. So this is where price rotates in a range rather than progresses. This is why balanced markets may feel choppy to some, but it's not because the market is confused, it's because the auction has reached temporary agreement. Now, in a balanced market state, effort rarely produces sustained results. Aggression is usually absorbed by liquidity on either sides of that range. Volume increases without distance, and breakouts tend to fail. This is exactly how a functioning auction behaves when value is accepted. Expecting trends inside a balanced market is a category error. Now contrast this with imbalance. An imbalanced market is a one-sided auction, hence the name. One side withdraws desire to do business. They remove liquidity on one side of that range. Liquidity thins or disappears, and price is now allowed to move from that range and find a new area of agreement. This is when markets expand, where you have an impulse or trend away from a range, not because aggression is strong, but because resistance is gone. This distinction matters because the same behavior means different things in different market states. So, write these next four statements down. They're very important. Because high volume in a balanced state often means absorption. High volume in an imbalanced state can accompany continuation. Low volume in a balanced state usually means nothing, where low volume in an imbalanced state can still produce very, very large movements. So without this state awareness, these observations are easily misinterpreted. This is also why breakouts fail so often, because in a balanced market state, liquidity is still present on both sides of that range. And when aggressive effort meets that liquidity resistance, it gets absorbed and price snaps back into a rotation. Now, a failed breakout is not necessarily a fake move. It is just a correct outcome in a balanced auction. So this gives us expectations. Now, trends, on the other hand, require imbalance. They require one side to step away. So that happens when liquidity is cleared on one side of that range. They're requiring permission, not force. So once price enters imbalance, behaviors change. Expectations should change. Pullbacks are usually very shallow. Rotations compress, and effort produces distance here. The market is no longer negotiating, it is discovering. So this lesson is about understanding what the market is trying to do. Is it seeking agreement, or is it searching for a new price? Until you can answer that, nothing else you observe can be weighted correctly. So by the end of this lesson, you should be able to classify any environment as either balanced or imbalanced and stop expecting the wrong behavior from the market. This classification doesn't tell you what to trade just yet. It tells you what's possible. What are our expectations of this phase? So, in the next lesson, we're going to build on this foundation by learning how to read participation, liquidity, and structure inside these states without assuming outcome.